Wednesday sees the UK Chancellor Rachel Reeves announce the latest autumn budget. And certainly she's got a tough task on her hands as she tries to essentially fix a black hole in the public finances without damaging the economy, without raising inflation, and putting the UK on a stable footing. That means we don't see a rise in terms of borrowing costs and we don't have to get back into this same position next time around. Will she be able to do it? What are the policies going to look like and what are the implications for markets? Let's get into that and more in today's video. As we can see here, essentially there is perceived to be roughly £30 billion worth of spending that needs to be cut or taxes that need to be raised. And certainly this is the key part of it, because you're looking at a Labour Party that, of course, wants to spend. They want to bring down child poverty. They want to be able to raise minimum wages, which is what they've done before. They want to raise equality throughout the country, essentially a Labour Party, right? So they have essentially a number of plans that they need to try and implement to be able to keep people on side within their own party. We've already seen some challenges on their leadership of late. But the flip side of it is that they've already spent the past, say, 6 months reeling from the effects or the after effects of what had happened previously within their spring budget, where they decided to raise minimum wages, where they decided to raise national insurance contributions for businesses. That in turn lifted inflation, and the UK has struggled with inflation ever since. Now, what's notable here is that you're talking about 30 billion. We don't necessarily know exactly what the figures are going to look like, because we'll have the latest updated forecasts for a number of different factors that go into these calculations, things like productivity and wage growth and GDP. So those forecasts will be interesting to see, and that will essentially tell us exactly where we need to be. Notably, these forecasts have, of course, been provided ahead of time to Rachel Reeves. And so that, in part, is why we actually saw the move that was mooted for a rise in overall income tax essentially taken off the table. They now think they can do it with a smorgasbord, as many people are putting it, of policy shifts. So a number of small shifts rather than one big shift. What's the benefit of that? Well, essentially, if you have lots of small cuts, so to speak, or hikes, depending on how you're viewing it, essentially you can look at that and think, oh, it's not too bad. It's not necessarily going to damage the economy too much, because you don't necessarily know exactly what the implications will be for each one. And lots of small things don't necessarily look as bad as one big thing like a rise in terms of income tax. The flip side of it is there's greater uncertainty. Now, with the rise in income tax, it's pretty much guaranteed what you're going to get back. So you're going to close the gap. You can build up your buffer essentially on top of that. That's not necessarily as secure when it comes to a whole raft of small policy shifts. And certainly that brings the possibility that we see higher bond yields off the back of that, because essentially the bond market is going to reflect, the perception of what the Bank of England's doing in terms of rates, but also the relative stability and the financial and fiscal stability within the UK. If you see a near enough seemingly guaranteed pathway to ensure that we're not back in this same situation next time that we have a budget, then it's likely that we see yields come down as a result, as there's not necessarily as much risk to be priced in to the markets. Now, in terms of this £30 billion mark, bearing in mind they have a gap that needs filling, but they also have the buffer that needs building. And I've got that roughly here. So we've got this fiscal headroom essentially. So you need to leave a little bit of a buffer in case or when these forecasts shift. And as you can see here, that buffer hasn't necessarily been massive. It's been just below 10 billion over recent years. Will that figure become bigger? If we do see a higher headroom figure, then of course that means they're going to have to raise more money in terms of taxes, but it also means that there's greater confidence within the markets that they have enough of a buffer to be able to deal with what comes down the line. And bearing in mind, the UK is not expected to have massive growth. So there's always a feeling that forecasts are always going to get downgraded rather than upgraded. Like I said, one of the key parts of this is going to be inflation. certainly we saw a significant rise in terms of inflation last time around. It wasn't just because of the policies within the budget, but significantly so. But alongside that, we had the rise in terms of the price cap on energy. And I think the energy side of it is going to be really interesting. Rachel Reeves has, as you can see here, vowed to get a grip on the cost of living. So what does that mean? Are they actually going to bring down costs for your everyday person? And does that mean that we're going to see inflation move lower? Disinflation, of course, if it comes from this, is a welcome move because it allows the Bank of England to cut interest rates. Markets now pricing a rate cut at something like 84% for December. So very confident of that rate cut, but still very elevated in terms of UK rates compared to some of the other regions that have already cut well over and above what the UK have done. So the Bank of England will be happy to cut rates at a faster clip, but they need to know that inflation's coming down in a meaningful manner. Now, as we can see here, that April figure is essentially the figure that really undermines the whole inflation picture in the UK. So that in part was down to the budget, the spring budget last time around. And so if you strip that out and you normalize that, if you were to take that April figure and make it look like an average of the rest of it, you can see that by and large, UK inflation is at a decent rate. I mean, ultimately, you can say that from a sort of annualized basis, the past 6 months take the UK headline CPI back down to target. But it's easier said than done. You can't just say, let's strip that out. But ultimately, it is in there. That inflation bump does exist. And the fear for many will be the possibility of a similar kind of move this time around. Of course, if you raise taxes, then it really depends where you're raising taxes from, because if you're raising on employers, as you've seen last time around, they then will pass that cost on to the consumer a lot of the time if they're able to, and soon enough you just have inflation. So keep an eye out on the policies that come out and try to gauge whether they're inflationary or not, because alongside this budget, we're likely to see some sort of shift in terms of potentially bringing down cost of energy for households. Maybe that's the removal of VAT on energy purchases, things like that, right? So they're going to try and make some sort of effort to say that they're addressing the issue of household inflation. But whether that's going to counteract the rest of the policies remains to be seen. And that could be one of the key determinants as to exactly how markets are treating this budget. Aside from that, there's a lot of talk of raising money from elsewhere. And, there's always, especially with the Labour Party, they want to tax the rich. And so the rich are the people that have mansions. And what is a mansion? Well, apparently a mansion is a property that is worth £1.5 million and above. Now, depending on where you are in the country, that might seem like a lot, or it might not seem like a lot, because certainly living in the UK or living in London, £1.5 million properties are pretty much everywhere, quite frankly. It's certainly not a mansion. It's a pretty standard house within many parts of London, not all. But it's really significant. So if you were talking about a mansion tax, if that comes into the fold, what kind of numbers are we looking like? Is it a really heavy tax on people that have houses that are worth a lot of money? Or is it like this, where it's going to be trying to take from many, which is something like 1.5 million and above, but then, adding an additional band for council tax. So they end up paying an additional something like 2,000 a year. I've heard on one estimate. That's going to be notable because, of course, it creates a skew when it comes to the market. It means that properties beneath that 1.5 million band probably don't really rise, because no one's going to be willing to buy it if it's worth over that, but they'd be willing to buy it if it's worth it below it, because then the tax implications are significantly less. So it means that the price movements within the housing markets aren't necessarily as fluid as they might be otherwise. And then it might have implications in terms of sales volumes and the like. So certainly there's implications for the housing market, no doubt, and they're not necessarily positive ones. In terms of the sort of GDP forecasts that you can see here, this from the OBR is going to be a key part of it, because you're talking about how optimistic or pessimistic are they compared to last time around. And you're looking at here where essentially this is according to Bloomberg, it's saying a likely downgrade to the productivity outlook will likely bring its GDP forecast closer to consensus. So that's part of the reason why we might not necessarily see as bad a picture coming into the fray this time around, but the productivity side of things is the downside move. The upside move potentially coming from better wage growth. In terms of GDP forecast going forward, you can see here that the UK, by and large, you can look at a number of different sources. We're not expected to grow at any sort of impressive clip going forward. 2024 was around 1.1, 2025, 1.3s, roughly 26, 1.2 to 1.3, 27, sort of maybe 1.5. So there's the outlook in terms of how this is going to impact inflation, which I think is going to be key. But there's also the outlook on how it's going to hinder the economy. Of course, tax cuts benefit the economy. Tax hikes hinder the economy, but potentially raise money that allows for lower yields in the UK, lower borrowing costs, because of the fact that there's a perception that things are a little bit more fiscally secure. So if you're looking at, say, the outlook for the UK economy, what would you be looking at? Maybe you could play it around the pound. Maybe you could play it around more domestically focused stocks. Certainly the FTSE 100 isn't necessarily geared that way so much because it's very highly internationalized. In terms of some of the different policies, this is one image that I thought was interesting because it shows you different policies and then tells you the popularity of them within the polling. And certainly you can see in terms of the wealth tax, undoubtedly that is a popular one. So it makes it more likely that it's going to happen. Notably, some of the deterioration we've been seeing recently in terms of GDP numbers, in terms of, to some extent, retail sales, but certainly in terms of house price declines, a lot of this comes because of the uncertainty that we've seen in terms of policies in the lead up to this budget. And part of it's because all of these different prospective policies being thrown out into the public, that gives them the ability to see what sticks and what doesn't, what's popular, what's unpopular. If there's a massive outcry around one particular policy, it's unlikely they're going to enact it because they don't want to be unpopular. But they've got a lot of different things they can choose on. Certainly, when you're looking at this is taking an angle where it's particularly looking around sort of investments. So talking about shifts in terms of cash allowance within ISAs. If we see a reduction to that, that could be interesting because maybe it pushes people more towards the stocks and shares ISAs, so greater sort of investment within the stock market. Removal of stamp duty on newly listed shares, again, perhaps greater interest into sort of UK stocks in particular. Increasing income tax, of course, not popular, and it doesn't look like that's going to be happening. The wealth tax, like we said, reducing pension contribution tax relief. So that certainly looks quite likely to come into play. So-called salary sacrifice potentially capped at £2,000. So a number of different things to watch out for. But what I think is key here, right, is that there's been a lot of fear that all of this is going to come into play, right? And so many people have been taking investment decisions off the back of that. That might be the case of someone saying, I think a mansion tax is going to come in. I'm going to get hit because I've got a £5 million house. I'm going to sell it and move abroad, whatever, right? But we don't actually know that these policies are coming into fruition. So perversely, essentially what's happened recently over recent months is that we've seen a number of outcomes that are in anticipation of what might not actually come into fruition. So in a way, I think there's going to be a sense of relief once the budget's out the way, because granted, some of the announcements won't be ideal, but maybe everyone fears the worst. Everyone thinks that the worst is going to happen. Maybe just a few points come through, and all these other things that everyone had been hearing in the newspapers, the scaremongering around all these different policies that are going to happen, maybe a lot of them don't actually come to fruition. Notably, recent price action has benefited the highly internationalized FTSE 100 at the expense of particularly the FTSE house builders. So clearly there's a feeling that the housing sector is going to get hit by this budget. Retailers also underperforming the domestically focused FTSE 250. But certainly, like I said, there is a possibility that we come into a position where there's an element of a relief rally for many, because there's fears around what could be rather than the reality of what actually will be. So certainly I'm expecting volatility to come into play. The outlook in terms of how it impacts inflation, I think, is going to be really important, because that gives us a lead on what the Bank of England's going to be able to be perceiving as well. And so with that in mind, let's just quickly look at a couple of charts before we close out. First and foremost, I wanted to bring up, here we go. So I wanted to bring up the chart for, this is essentially some of the major indices, just to see exactly how the FTSE is performing. And we can see, let's see over the last, say, month, right? So the FTSE 100 is roughly, oh, it's at the top of the pile when you look over the course of the past month. So holding up really well. And in actual fact, you would say the FTSE is perfectly positioned for exactly what's happening at the moment. The tech sector getting hit, particularly around AI. The UK has basically nothing when it comes to tech and AI. So it's certainly not an index you'd be selling based on fears around AI. Also, people are concerned about the stability within markets, so they're going to be heading more towards stocks that are paying dividends. That's something that you do get within the UK. You've got an element of defense stocks, and of course, there's an element of people trying to get into sort of defensive stocks. I know there, of course, might be some sort of conclusion to the Russia-Ukraine issue, but nonetheless, defense stocks have done very well leading up to this point. And then commodities. I mean, look, you know, we have seen some downside over recently over precious metals and oil and gas. But nonetheless, I think commodities, particularly around the precious metal space, have served the FTSE 100 very well of late. And there is a perception that once we get through one hurdle after another, whether it's the US-China issue, or whether it's trade issues, all of them seem to benefit the outlook going forward for commodities, particularly things that are related with development like copper. And so mining companies should do well because of that. So the FTSE has done pretty well over the course of this fairly tumultuous period for markets. If you look at all of these markets, you know, up 1.7, I mean, you've got the DAX down 4, the Russell 2000 down 4, Amsterdam down 4, the NASDAQ down 3%, the CAC. So it's been doing incredibly well. Now let's look at the FTSE from the daily time frame. So bear in mind that we're in a period of uncertainty for the UK in terms of growth, in terms of policy in particular. And so despite that, we've seen this lovely trend over the course of this year, essentially. Now, we've pulled back into this ascending trend line of late, and we've seen this bullish engulfing candlestick formation closing out on Friday. Now, we're seeing a bit of weakness, but we gapped higher to begin with. Now we're drifting a little bit lower. I think there's a good chance that we've bottomed out here. I mean, obviously, this is also heavily tied into what's happening over in the US. You can say, well, we don't really have many tech stocks, and therefore people like to head to the FTSE. That's great and everything, but there is an element of contagion. If equity markets in the US collapse, the UK markets are certainly not immune to those moves. People will sell out of positions across the board, and certainly there's plenty of UK investors that are invested over in the US as well. And if they start taking losses on one position over in the US, they're not necessarily going to say, "Oh, all of my positions in the UK are essentially ring fenced and protected." That they also would sell out of positions in the UK. But it has held up very well during this period. It's pulled back into the 76.4 fib and ascending trend line. Bullish engulfing candlestick formation. That to me means that the short-term downside is likely to be a short-term fleeting move before the bulls come back into place. So if we break through this recent low that we have down here of 9423, then fair enough. My perception is wrong. But we've seen an intraday trend of lower highs, lower lows. Then we break up through, tentatively through your first swing high, 95.94. That means that the next sell-off is likely to be a higher low before we then move higher once again. So, like I said, unless we break the 94.23 mark, I'd expect this to do well. And in terms of the budget, I think it could be a sort of sell the rumor, buy the fact event, right? Any fears leading into it, I think are likely to be cast aside because only a handful of these measures are actually going to be enacted. And certainly key to it will be the outlook in terms of inflation. In terms of the pound, you can see here cable has this sort of big topping pattern from a wider perspective. Let's go monthly. The wider perspective is bearish for cable, right? And the question mark here is, are we pulling into another retracement phase? I think that's likely, right? So you can see we have these big swings. I think, do we top out here? You could look at this and say, we're going to top out here and sell off heavily. I'm not necessarily going to hang my hat on that because I think there's going to be an interesting narrative next year, in particular around the US dollar, where we might see some strength at the time being. But next year, there's going to be some big question marks about the independence of the Federal Reserve, because they're essentially going to bring interest rates down to what they perceive to be the right level, which is, 2 or 3 rate cuts on from here. And then you're going to see Donald Trump put a new Fed chair into the hot seat. And what are they going to do? Are they going to do nothing and say that we think that policy is perfect? Or are they going to do what Trump's told them to do, which is basically try and get everyone on side for additional rate cuts? So that essentially points towards a loss of independence at the Federal Reserve, and in my mind weakens the dollar, which again is part of the policy for Trump. But for the time being, we've seemingly topped out. We could very easily be swinging into another one of these retracements. And for, I think we've got further downside to come. Now, from a pound perspective, it's about what the outlook is in terms of the Bank of England. Markets essentially think it's a given that we're going to see a rate cut now from the BOE, but we've just seen comments from Williams on Friday, I believe it was, or over the weekend, and he's essentially saying that he thinks that it would be appropriate to cut rates in the near future. Market's now pricing it as the base case scenario for a rate cut in December from the Fed as well. So that's pushing things upwards a little bit here. But nonetheless, I think there's a good chance we do see further downside coming into play. But from this budget, the key question mark here is, do we see policies that are inflationary by nature that causes another April-style spike? Or do we see a budget that manages to tread that line very well and in actual fact announce policies that will lower costs for households and keep on the trajectory that's been in play for the last 6 months since that April release? After that, inflation has been under control. And if we continue to move on that pathway, and if the budget doesn't mess it all up, then the Bank of England will have a nice runway to be able to cut rates in a more meaningful manner in 2026, and that should drive the pound lower as a result. Of course, we're looking at the pound against the US dollar, but I would keep an eye out also on the pound against the euro or euro sterling, because the ECB have already finished their rate cuts. It's something we've been talking about for quite a while now. It's been working out really well in terms of the rise of euro sterling. If we see a inflationary, if we see a budget that essentially doesn't cause concerns around inflation, that could lead euro sterling towards the upside as well. I hope that's been useful. Make sure to like, subscribe, and follow for more. It's going to be an interesting week. We've got plenty of data to get through as well. But certainly from the UK perspective, this budget is going to be a particularly big one to watch out for on Wednesday.